Have you ever just stopped and wondered, what is an idea really worth? I mean, not just a random thought, but a real innovation, a potential game changer. Think about it. Firms pour billions into R&D, but figuring out the value of what comes out the other end, something as abstract as a new invention, well, that's one of the toughest nuts to crack in all of economics.
So let's just ask the question straight up. How much is a new idea worth? It's not like you can just look it up on a stock ticker, right? Its true value might not show up for years, or it might end up being worth absolutely nothing. And that deep uncertainty, that's really the heart of the mystery we're going to try and solve today.
All right, so to crack this code, we've got a roadmap. First, we're going to lay out the billion-dollar question itself. Then, we'll dive into the breakthrough idea that changed the whole game. We'll follow the clues in the data, see how the decision was modeled, uncover the skewed reality that the model revealed, and finally, we'll talk about the absolute revolution this one single idea kicked off. Okay, so firms are investing these huge, enormous sums of money to innovate and lock down patents. But the real value of all that intellectual property, it's hidden. You can't see it directly, it's not traded on some open market, and that presents a massive, massive challenge for anyone trying to understand what really drives economic growth.
You know, for years, economists were kind of banging their heads against the wall trying to get a handle on this. They'd sift through accounting data or look for simple correlations. But those old methods just weren't cutting it. They treated innovation like it was this static, predictable thing, when we all know it's dynamic, it's messy, and it is profoundly uncertain.
And then, in 1986, came the breakthrough. An economist named Ariel Pakes published this amazing paper. It later won the Frisch Medal, and he proposed a completely new and way more powerful way of thinking about the problem. He didn't just offer a better way to measure things, he gave us a much, much better idea.
And this was a huge conceptual leap. I mean, the old way of thinking saw a patent as a static asset, kind of like a piece of machinery that just slowly wears out over time. Pakes' view? Radically different. He said a patent is a real option. It's the right, but, and this is key, not the obligation to make a future investment. It's like owning a ticket to a future opportunity, not a guaranteed prize.
So, the whole thing boils down to this. The value of a real option comes from flexibility. In a world full of uncertainty, having the choice to invest later or to just walk away is incredibly valuable. You get to wait, see how the market shakes out, and only then do you have to commit the big bucks. The patent is what keeps that choice alive.
Now, this was a fantastic idea, but an idea is just an idea without proof. Pakes needed data to back it up. He had to find a way to see the hidden value of these options in action. And he found the perfect clue, hiding in plain sight, inside a simple, routine decision that thousands of companies were making, year after year.
And that clue was buried in patent renewals. See, in a lot of European countries, to keep your patent active, you have to pay a fee every single year. And this little bureaucratic detail, it turned out to be an absolute economic goldmine, because it forces the patent holder to make a decision.
The logic here is just, it's beautiful. It's so simple. Every year, a company looks at its patent and thinks, what's the future potential here? They weigh that potential value against the cost of the renewal fee. If they pay up, they're basically shouting, we believe this thing is worth at least what we're paying to keep it alive. And if they let it lapse, they're sending the exact opposite signal. Their actions are revealing what they secretly think it's worth.
And this quote from Pakes' paper just nails it. The decision isn't just about what the patent is earning right now. It's about the current returns plus the value of the option to keep it going for the future. Firms were literally paying money just to keep a possibility open.
Okay, so Pakes had his core insight, and he had the data. The next step was to build a machine, a really sophisticated econometric model that could take these thousands of little renewal decisions and translate them into a big, clear picture of how patent values were actually distributed.
And let me tell you, building this thing was not easy. Pakes basically modeled the firm's decision as a constant, forward-looking puzzle under uncertainty. This approach, called dynamic optimization, was totally cutting-edge stuff for the 1980s. I mean, this was pushing the absolute boundaries of what was computationally possible back then.
So after all this brilliant theory and incredibly hard economic work, what was the big reveal? What did Pakes' model actually uncover about the hidden world of innovation? Well, the answer would completely change how we think about the economics of invention.
It turns out reality is incredibly skewed. It's not some nice, gentle bell curve. Nope. The vast, vast majority of patents are worth next to nothing. They're just ideas that don't pan out. But a tiny, tiny fraction of them, They're worth an absolute fortune. They generate unbelievable returns.
And here's the killer number to prove it. Pakes' results show that the top 5% of patents, that's just 1 in 20, accounted for about half of the total value of all patents. Just let that sink in. Half the value is concentrated in this tiny sliver of elite innovations.
And when you actually see it visualized as a chart, it is stark. The value of that top 5% just towers over everything else. This isn't just a quirky stat. It shows that innovation is a winner-take-all game, where just a few huge breakthroughs drive most of the economic impact.
But here's the thing. The impact of this paper went way beyond just understanding patents. Pakes' insight and his methods, they kicked off this quiet revolution in economics, giving researchers a whole new toolkit for thinking about strategy and investment.
The real options framework basically became a fundamental concept. All of a sudden, economists had this powerful new language to talk about any big decision made under uncertainty. Whether to build a new factory, enter a new market, anything. It was a massive conceptual breakthrough.
And you can see the DNA of Pakes' dynamic approach everywhere now. It was adapted to study all sorts of critical business decisions: when to enter or exit a market, when to invest in new tech, how to compete. It really became a cornerstone of modern industrial organization, which is the whole field of economics that studies how firms compete and behave.
Which leaves us with one final and really crucial question. Pakes showed us how to find and value the options of the industrial age by looking at these simple renewal decisions. But in our economy today, which is driven by intangible stuff like software, AI models, and big data, the options are more abstract than ever. So the challenge for us now is, how do we spot the truly valuable ones that are going to define our future?